Picture this. It is Friday, 4 post-meridian Eastern Standard Time. The charts on your screen are not just volatile, they are a crime scene. 48 hours ago, the price of silver capitulated, crashing down to the psychologically critical level of $65 per ounce. The retail investors panicked, the weak hands folded. And then, in a violent, vertical move that defies all conventional logic, the metal rocketed up 22%. We are talking about a move from $65 back to nearly $80 in just 2 trading sessions. This is not normal market behavior. This is a fracture in the mechanism of price discovery. While the paper price on the COMEX was flushing down the toilet, the physical premiums at the dealers were exploding. The disconnect between the paper map and the physical territory has never been wider. I need you to stop what you are doing right now. Turn off the television. Close the entertainment tabs on your browser. What we are witnessing is not a market correction. It is a liquidity event that could define the next decade of wealth transfer. Before we dissect the cadaver of this market move, I want you to go to the comment section below. Tell me where you are observing this chaos from. Are you in London, Singapore, or New York? Leave a comment now. Let us begin the autopsy. Let us put on the gloves and examine the body of this trade. To understand why silver plummeted to $65 and then violently rejected that level, we must first ignore the news headlines. The news will tell you it was interest rates. They might tell you it was a geopolitical de-escalation. Those are distractions for the retail crowd. The truth lies in the mechanics of the futures market, specifically the COMEX leverage structure. First, we need to address the drop. Why $65? This was not a fundamental revaluation. The industrial demand for silver did not vanish overnight. What we witnessed was a classic liquidity event. When the broader equity markets, the S&P 500, the Nasdaq, begin to shake, hedge funds receive margin calls. They need cash and they need it immediately. They do not sell what they want to sell. They sell what they can sell. Silver is a highly liquid asset in a crisis. It is the first thing they dump to cover their losses elsewhere. This is what we call throwing the baby out with the bathwater. The algorithm triggered a cascade of sell orders, punching through stop-loss levels like a knife through hot butter. However, observe the recovery. A 22% rally in 48 hours is not a normal market correction. It is a sign of a broken market structure. We need to look at the open interest. Open interest represents the total number of outstanding derivative contracts that have not been settled. Here's the forensic detail you need to understand. If the price of silver crashed and open interest increased, it would mean aggressive short sellers were piling in, betting the price would go lower. But that is not what the data shows. As the price dove to $65, open interest collapsed. This tells us that the long positions were being liquidated by force. The weak hands were washed out. The speculators who bought on margin were wiped out. And then, the vacuum effect occurred. When the selling pressure exhausted itself, there were simply no sellers left. The order book became thin. The moment a large buyer stepped in, likely a sovereign wealth fund or a bullion bank covering their short position, the price had nowhere to go but up, vertical. This is what we call a V-shaped recovery. Now let us look deeper at the commercials. These are the bullion banks, the entities that actually handle the physical metal. For months, they have been net short, suppressing the price. But at $65, something changed. The commitment of traders report, which lags by a few days, will likely show that the commercials used this crash to flip their position, and they covered their shorts at a massive profit and potentially went net long. They transferred their risk to the retail speculators who were panic selling at the bottom. There is another critical piece of evidence: backwardation. Normally, the future price of silver is higher than the spot price. This is called contango. It accounts for storage and insurance costs. But during this drop to $65, we saw a momentary backwardation in the near-term contracts. The spot price became more expensive than the futures price. Do you understand the implication of this? It means the market is screaming for physical metal right now. Traders were willing to pay a premium to get the metal immediately rather than wait for delivery next month. This is the ultimate signal of physical scarcity. Now, the paper market was saying, sell, but the physical market was saying, we are empty. We also need to discuss the exchange for physical, or EFP market. This is the bridge between London and New York. When the spread between these two markets blows out, it indicates a logistical breakdown. While the chart on your screen showed silver crashing, the premiums for 1,000-ounce bars in London were likely rising. The arbitrage mechanism, which keeps prices aligned, is fracturing. So, was the drop to $65 a fakeout? From a forensic perspective, yes, it was a bear trap. It was designed to trigger your stop losses, take your position, and then leave you behind as the train left the station. The 22% rally is the market trying to find the true equilibrium price, which is likely far higher than even the $80 mark we are approaching. But be warned, the volatility is not over. The banks know that retail investors chase momentum. Now that the price is rising again, they will wait for you to pile back in with leverage, and they will try to shake you out one more time. They are hunting for your liquidity. Do not give it to them. We have dissected the crash and the rally. But to understand why this floor at $65 is so concrete, we need to look at the history books. We need to compare this moment to the Hunt brothers era and the crash of 2011. The patterns are repeating, but the scale is entirely different. To understand the gravity of a $65 floor, we must look at the ghosts of the past. History does not repeat, but it certainly echoes. Oh, most analysts look at the chart and see a random dip. I look at the chart and see the ghost of 1980 and the shadow of 2011. Let us rewind to 1980. The Hunt brothers attempted to corner the silver market. They used leverage, they used paper contracts, and the establishment changed the rules to break them. They raised margin requirements, forcing a liquidation that crashed the price from $50 down to $10. That was a paper crash. It was a manipulation of the rules to protect the short sellers. Now, fast forward to the year 2011. Silver once again touched $50 per ounce. That was the ceiling. That was the resistance level that could not be broken. For over a decade, $50 was the graveyard of bullish dreams. But look at where we are today. The price crashed to $65. Do you see the inversion? The ceiling of the past has become the floor of the present. When an asset class turns its previous all-time high into a support level, it is no longer a commodity trade. It is a monetary reset. $65 is not expensive. Historically speaking, adjusted for real inflation and the debasement of the currency, $65 is the new zero. However, the most critical piece of forensic evidence is not in New York. It is in Shanghai. While the Western markets in London and New York were panic selling paper contracts to drive the price down, the Shanghai Gold Exchange was operating in a different reality. This is the East-West arbitrage disconnect. Usually, the price of silver is the same globally. If it is cheaper in New York, traders buy it there and sell it in Shanghai for a profit, equalizing the price. But that mechanism is broken. During the dip to $65, the premium in Shanghai likely remained significantly higher. We are seeing a spread of nearly 10% between the East and the West. This means physical silver is leaving the vaults of the London Bullion Market Association and the Commodity Exchange in New York. It is being loaded onto armored transport, flown across the ocean, and melted down into kilogram bars for the Asian market. This is not just a trade, it is a migration of wealth. The West is selling its strategic reserves of silver to cover paper losses and margin calls. The East is buying that physical metal to back their industrial dominance and their currency reserves. China knows what is coming. The BRICS nations know what is coming. They are not buying silver for a 22% trade. They are buying it because they know the paper derivatives market is mathematically impossible to sustain. When you see the price plummet to $65, do not think of it as a loss of value. Think of it as a transfer of ownership. The weak hands in the West are gifting their generational wealth to the strong hands in the East. The COMEX is becoming a delivery mechanism for the Shanghai Gold Exchange. This geopolitical shift is the engine driving the 22% recovery. The moment the price dropped, the vacuum cleaners in the East were turned on full power. They absorbed every available ounce. And that brings us to the most terrifying part of this equation, the industrial reality. While the bankers play games with paper, if the factories are running out of metal. Now, we strip away the financial noise and look at the physics. The bankers in London and New York can print paper contracts until their keyboards break. They can create 1 billion ounces of digital silver out of thin air to suppress the price. But they cannot print a single ounce of physical metal. And this is where the narrative of the $65 crash falls apart completely. While the chart showed a panic, the industrial supply chain was experiencing a seizure. We are entering what I call the Unobtainium phase. Let us look at the solar industry. The demand for photovoltaic cells is not linear, it is exponential. Governments around the world have mandated a transition to green energy. To achieve the target set for the year 2030, the solar industry alone will need to consume nearly 100% of the global silver mining supply. That is a mathematical certainty. Silver is the most conductive metal on the periodic table. It is not a choice, it is a requirement of physics. You cannot build an efficient solar panel without silver paste. You cannot build a high-performance electric vehicle without silver contacts. You cannot build the advanced circuitry for artificial intelligence servers without silver. When the price dropped to $65, did the mine suddenly produce more metal? No. Did the demand for solar panels vanish? No. In fact, the lower price acted as a massive subsidy for the industrial users. Samsung, Tesla, and the major Chinese solar manufacturers likely used that dip to secure physical delivery for the next 2 years. And then they drained the wholesale market dry. This is the just-in-time inventory failure. For decades, industries kept very little silver on hand, relying on the market to deliver it when needed. But when the price crashed and then rocketed 22%, it sent a shockwave through the supply chain. It told every industrial buyer that the metal might not be there tomorrow at any price. And do not forget the military application. We are living in a time of escalating geopolitical conflict. Every Tomahawk missile, every fighter jet, every satellite guidance system requires strategic amounts of silver. The Department of Defense does not care about the spot price on the COMEX. They care about availability. When the price dips, they do not sell, they accumulate. We are seeing reports from bullion dealers that premiums on physical bars did not drop when the spot price hit $65. In a normal market, if the price drops, the cost to you should drop. But in this market, the spot price dropped and the premiums rose. That is the market screaming that there is no metal available at the paper price. The 22% rally is the market realizing that the paper price was a lie. The miners cannot operate profitably at lower levels due to rising energy costs. The ore grades are falling. We are digging deeper and finding less. So, when you ask if $65 was the bottom, look at the mine supply. It is flat. Look at the industrial demand. It is vertical. The gap between those two lines is where the price explosion happens. We are not just looking at a price correction. Oh man, we are looking at a supply crunch that could make the palladium squeeze of the year 2019 look like a minor blip. The paper market tried to tell you silver was worthless. The industrial market just told you it is priceless. So, we arrive at the final question. The question that determines whether you survive the next phase of this financial reset or become a statistic. Is the low of $65 the absolute bottom? Or is this a fake-out designed to trap the bulls one last time before the real liquidation begins? Let us be surgically precise here. In a manipulated market, there is no such thing as a guaranteed bottom. The charts are painted by algorithms, not by supply and demand. The banks have the power to push the paper price to any number they desire in the short term. On that, they could push it back down to $60. They could push it to $50. If the stock market crashes tomorrow, if we see a liquidity event in the S&P 500, the paper price of silver will likely fall in sympathy. This is the nature of the beast. When the margin clerks call, everything gets sold. However, and this is the most critical distinction you must understand, the paper price is not the physical price. We are approaching a singularity point, a moment where the spot price on your screen and the price to acquire actual metal diverge completely. We call this the decoupling. If the paper price crashes again to retest the lows, do not expect to walk into a coin shop and buy silver at that price. You will find the shelves empty. You will find delivery delays stretching from weeks into months. and you will find premiums exploding to 50% or more. The lower the paper price goes, the faster the physical metal disappears. This is the mechanism of the Gresham's law of the 21st century. Bad money, the paper contracts, drives out good money, the physical silver. So, here's your forensic strategy. This is not financial advice. This is a survival manual for a collapsing currency system. Rule number 1, eliminate leverage. The volatility we just witnessed, a drop to $65 followed by a 22% rocket, is designed to kill leverage. If you are trading silver on margin, if you are using 3 times leveraged exchange-traded funds, you are walking through a minefield. The banks see your stop losses. They know your liquidation levels. They will swing the price violently in both directions to wipe you out before the real move begins. Do not give them your position. Own the asset outright. If you cannot hold it in your hand, you do not own it. You are merely a creditor to a bankrupt counterparty. Rule number 2, watch the premiums, not the spot price. Stop obsessing over the ticker tape. The spot price is a distraction. The real signal is the premium. If the spot price drops, but the price of an American Silver Eagle or a Canadian Maple Leaf stays high or increases, that is the market telling you the bottom is in. That is the wholesale bid supporting the market. The smart money is not selling. They are accumulating. When the spread between paper and physical blows out, it means the paper market is broken. Do not wait for the spot price to confirm your bias. Trust the physical tightness. Rule number 3, the dollar cost average defense. Trying to time the perfect bottom is a fool's errand. You will miss it. The psychological pressure when the price is crashing is immense. You will be paralyzed by fear. The strategy of the professional is accumulation. You buy when it hurts. You buy when the headlines are screaming that the commodity supercycle is dead. You buy when the price is $65. And you buy if it goes to $50. You are not trading for profits in fiat currency. You are trading your dying fiat currency for the only form of money that has survived for 5,000 years. We are looking at a scenario where the currency itself is the risk. The debt of the United States is mathematically unpayable. The only way out is inflation. Or they must print the value of the debt away. This means the denominator, the dollar, is going to zero in real terms. In that environment, the price of silver does not just go up, it becomes the measuring stick of the collapse. The 22% rally we just saw is a warning shot. It is a glimpse of what happens when the short sellers lose control. It happened fast. It happened violently. And next time, it will not stop at $80. It will gap up. You will wake up one morning and the price will be $100 and there will be no sellers. Do not be the person waiting for a pullback that never comes. Do not be the person holding paper contracts when the exchange declares force majeure and settles your claim in worthless cash instead of metal. The window of opportunity is closing. The transfer of wealth from the west to the east is accelerating. The industrial vacuum is running at full capacity. The physical floor is solid concrete, reinforced by the demand of billions of people who are waking up to the reality of fiat currency debasement. I want you to look at your portfolio. Look at your savings. Are they in a bank that is insolvent? Are they in a currency that is being printed to infinity? Or are they in an asset that has no counterparty risk? The choice is yours. You can trust the government statistics, you can trust the central bankers, and you can trust the paper price. Or you can trust the periodic table. You can trust physics. You can trust history. This rally was not a fakeout, it was a revelation. The market showed its hand. The paper tigers are weak. The physical bull is awake. I've compiled a full technical dossier on the critical support levels we just tested, including the specific indicators that signaled this reversal before it happened. The link is in the description below. Access it before the next volatility spike. Do not let them shake you out. Do not let them scare you out. Hold the line.